Hi, and welcome to Chapter 2, Excel Problems. I originally didn't think I was going to have a Chapter 2 Excel video, but there are a couple of quantitative small problems in Chapter 2 that could pop up on the homework or on the exam, so I figured I'd go over it using Excel. This first one is looking at purchasing Berkshire Hathaway stock with a $6 commission for the trade, buying one share, and having a bid and an ask of 260,000 plus. Berkshire Hathaway is a very large share price, about that much, so it's actually larger today. But to calculate the bid, the ask spread, this is simply entering in the ask price, which is up here, and then the bid price, and then finding the difference of the two, which would be 920. So that would be the spread. Question B, if TD Ameritrade routes your buy order to the New York Stock Exchange where Berkshire Hathaway is listed, what is the potential minimum of your transaction cost? Well, that would just be your commission of $6. Be commission only. C, if TD Ameritrade routes your order to the NASDAQ where Berkshire Hathaway is not listed, what is the potential minimum for your transaction costs? Okay, so it would be 50% of the bid-ask spread. So we would take the spread and we multiply that by 50% because it meets it in the middle. Because now we're going through the NASDAQ, so they have a different way of calculating the costs. We'd have to split the bid-ask spread, and then we'd still be paying the commission. So the total would be just adding these two together. And remember, this is a corporate finance, not personal finance. So this is not something you'd experience when you buy a stock from the NASDAQ. Okay. Now let's see here, Part D. Regardless of how your trade is executed, calculate the bid/ask spread. What is the market value of your trade? Okay, so we have our ask price here, we have our bid price here, and we're gonna sum the two of these and then divide by 2. But before I do that, I'm going to put brackets around adding these two together. So this would be, then I would, number of shares is 1. So to calculate the market value, I would take the sum of the bid ask divided by 2, and I multiply it by the number of outstanding shares to get the market value of the stock. So if you're looking for an implied value, the implied value is the bid plus the ask divided by 2 times the number of shares. And that's what they mean. So when they ask for, here they're saying the market value, but if they ask for a market value or implied market value, this is how we would calculate that. Okay. Question 2, transaction cost question 2. So here we have decided to sell a losing position in Twitter, and you can capture the loss to use it to offset some capital gains, reducing your taxes for the year. You believe Twitter is a good long-term investment. You wish to buy back your position in February. You call Charles Schwab brokerage account manager to request that it sell 1,000 shares of Twitter, and then you're going to buy them back in February. And Charles Schwab charges commissions of $25 as broker-assisted trades. So suppose your total transaction costs are, for selling 1,000 shares is $45. What is the bid-ask spread for Twitter at the time of the execution? Okay. So the transaction costs are going to be, how we calculate the transaction costs is the number of shares, which are 1,000, times 50% of the bid-ask spread plus the brokerage commission. So if I want to get the bid-ask spread, I have to take the transaction costs, which we know are 45, minus the commission, which is 25, and then I'm going to divide that by the shares times 50%. So let's try this out. Okay, so I'm going to start the equation, and I'm going to open parentheses, transaction costs minus the commission And then I'm going to divide that by the shares of stock. Times 50%. And we come up with 0.04 would be the bid ask. That's how we calculate the bid ask spread, and that's per share. Okay, so then question B, given that Twitter is based on the New York Stock Exchange, do your total transaction costs for December seem reasonable? Explain why or why not. Okay. So for B, this is how I would explain it. This statement is basically true. So Twitter is from the New York Stock Exchange, a broker's market. So if Charles Schwab had to route the order to the New York Stock Exchange, it could have executed a buy order, and the total transaction cost would have just been the brokerage commission. But if the transaction is going to include a bid and ask spread, so the order, went to the New York Stock Exchange, there was no way to, no shares available to buy, so thus it was routed to a market maker in the NASDAQ for 1,000 shares. So it would be at cost, which is half the bid-ask spread per share, and then Charles Schwab would route it to a dealer on the NASDAQ, and the market maker added the shares to the inventory at half the spread. So basically, the way the brokerage and the market maker are working together, they're going to split the cost of the bid-ask spread because it's coming, they're sharing that revenue. And again, this is business-to-business transaction in the market. It's a little bit different than your personal account, but that would be a true statement. Okay. C. When your February statement arrives in the mail, you see the transaction cost of 1,000 shares of $42.20. What is the bid-ask spread for Twitter at the time the trade was executed? Okay, so this is similar to the formula of this problem A. We're just saying we're going to go back into this transaction, so we're going to calculate the spread. So we're going to use a similar formula. Now I could just copy this formula down here, and that's the beauty of Excel. But if I was going to recalculate it, again, I would do the same thing we did before. Open parentheses, transaction costs minus commission costs, close parentheses, divided by, open parentheses, the number of shares times 0.5. Why 0.5? Because they're splitting that. They're going to be splitting the bid and ask on the exchange. So this would be the bid-ask spread between the bid and the ask of an individual share of stock. What are your total round-trip transaction costs for both selling and buying shares, and what could have been done differently to reduce the total costs? So we do our purchasing costs here. Our purchasing costs were $45. Actually, no, we're not going to do it that way. I'm just going to take, since the transaction costs are right here, I'm just going to take the number from here and put that in the cell, and then this is on the, the purchasing side. This is where we're actually, because we sold it first, and then we're going to buy it back in February. So the actual purchasing is here, and then the sale was up here. So the round trip would just be adding these two together, and that would be the round trip transaction costs. And the cost could have been reduced if both trades were traded on the NASDAQ and it wasn't crossed over to the New York Stock Exchange. Okay, so that's how you would do that. Now, the IPO, this is the third problem here. We're talking about the initial public offering, and it's saying that this company, Yext, so like Next with a Y, sold 10,500,000 shares of stock at an offer price of 11 with an underwriting discount of 77 cents per share, and the closing price of the first day was $13.41, and the amount of outstanding shares was 85 million shares were outstanding. Okay. I think they... okay, so let's look at the problem here. Calculate the total proceeds. So this is just the amount of IPO shares issued times the offer price. Now the percentage underwriting discount, I would just divide the discount into the initial share price to get the percentage. Now the C, calculate the dollar amount of the underwriting fee. Again, this is just a simple multiplication of fees times the underwriting discount per share. And then calculate the net proceeds. So that would be the total proceeds minus the underwriting fee. So 107. I have these little hints here as you're doing it. Calculate the IPO underpricing as a percentage. So say underpricing percent. And to do that, we would take open parentheses, the market price, minus the offer price, close parentheses, divide by the offer price. So 21% underpricing. And then the market capitalization. Okay, so the IPO did sell 10,000 shares to the public, but the total amount of outstanding shares, the public shares of the 10 million public shares and probably 75 million private, yet shares owned outside of the public, gives us the total of what they say is 85 million. So to get the market capitalization, which means what's the value of the company, we can take all of the shares, both public and private, and multiply it by the ending market price. And then we'll get the value of the company is. So this company would be valued at over $1 billion. Okay, so that's how you would solve the IPO problem. Okay, thanks for your time. I hope you found this helpful. Take care.